I think small cap growth stocks have tremendous potential going forward. And I wouldn't try to say that that means over the next 3 months or the next 6 months or 12 months, but over the long term. And the reason for that, I think, can be summed up in one word, and that one word is innovation. Technology has advanced significantly over the past several years. Nobody would disagree with that. And these changes in technology have led to tremendous changes in how businesses operate, and changes in terms of how consumers consume, changes in terms of how pharmaceutical companies and biotechnology companies perform research, changes in terms of how healthcare is delivered to individuals. So you can see change creates opportunity, and entrepreneurial companies and individuals seize upon these opportunities to build new businesses. They take existing business models and they turn them on their head. And over time, those companies that are successful in taking advantage of these changes can create a tremendous amount of value for their stakeholders. And these changes and this innovation is happening. It's not just isolated to the technology and the healthcare sectors, but it's happening across our economy. It's happening in the financial sector. It's happening in the industrial sector. It's happening in the consumer sector. And this is what makes it so exciting to be a small cap growth investor. And as long as we have innovation, which I believe we will always have innovation, there will be great growth opportunities in the small cap part of the market. We had very strong stock selection throughout 2020 in the information technology sector, in the healthcare sector, in the industrial sector, in the communications services sector. Just a couple of examples that I would highlight. Within technology, we owned several software companies entering 2020. And these companies were growing very rapidly prior to 2020, which is why we held them in our growth portfolio. And in many cases, COVID actually accelerated the growth trajectory. So a couple of examples. We own a company that provides, or companies that provide software and services to e-commerce companies. So as consumers shifted their buying behavior to almost exclusively online in early to mid 2020, the demand for the software and services of some of the companies that we owned accelerated pretty dramatically. Similarly, we owned and we have exposure to companies that provide advanced call center software, so cloud-based software that help call centers operate more efficiently. As you can imagine, given, again, what I just talked about, the dramatic change in terms of consumer buying behavior and the move to online and e-commerce, this caused a dramatic spike in the demand and the need for efficient call center operations. And our companies benefited from that accelerated demand. In the area of communication services, it's interesting. I'll highlight a specific name here. We owned a company called Bandwidth Communications. And Bandwidth is a company we bought in late 2019. And Bandwidth, the simple way to think about them is they provide telecommunications services for apps such as Zoom and Microsoft Teams. We were very excited about owning Bandwidth entering 2020 because we felt they could sustain 20 to 25% growth for a very long period of time. And then when COVID happened and we had this massive shift to a work from home environment, needless to say, it had dramatically positive impact on Bandwidth's growth in 2020. And Bandwidth was one of our better performers from a stock perspective. The last sector that I'll comment on, and I want to comment on industrials because there was a fairly significant change for us over the course of 2020. We entered 2020 underweight the industrial sector, and the weights that we did have within industrials were more defensive. We owned distribution companies. We owned some waste companies, companies that don't necessarily benefit from a real significant increase in economic activity. And then again, because they are defensive, they don't feel the real lows of a dramatic pullback in economic activity. Well, when COVID struck, and COVID really impacted a lot of industries significantly, and on the industrial side, several companies, the majority of companies couldn't manufacture for a period of time. This caused havoc on their financial statements. Many of those stocks sold off very significantly. And to us, that meant opportunities. So we spent the better part of mid-2020 rolling up our sleeves and analyzing several more cyclical industrial companies, but at the end of the day, relative growth stories. And we made a shift in our portfolio over that time frame. So not only did we go from being underweight industrials and being defensive, but we went to being overweight industrials and more cyclical in our exposure. And that ended up being a really positive, or having a very positive impact on our performance in 2020. Investors should always consider investing a portion of their portfolio or nest egg in a small cap growth fund, even when markets appear to be rotating into value because of innovation. Innovation does not stop because the market is rotating. We consider all the major macro factors in all the investments that we make. Right now there's a lot of consternation around interest rates, and interest rates absolutely can affect stock valuations. And in particular, perhaps you've heard this, but a lot of people say, small cap growth stocks are really the ultimate long bond, right? Because small cap growth companies, they won't have significant earnings or free cash flow until 5-10 years into the future. And then when that free cash flow is 10 years out and you're discounting it back at a much higher discount rate, well, that's not worth as much today. So we pay attention to that. I think what it creates in the short to intermediate term, again, are opportunities. The macro factors such as this, unless there were significant government regulations that clamp down on innovation and on companies' abilities to maneuver and become innovative in a sector that they participate in, innovation is not going to change, and change is going to continue happening. And these secular changes, again, this is what creates new markets, and it creates opportunities for small, agile entrepreneurs. Volatility, if you don't have the right approach or if you're not grounded, can be very frustrating, especially when it's working against a particular stock that you own or against a sector where you happen to have several investments. But again, a good investor needs to be grounded in their investment thesis. If your investment thesis remains firmly in place on a particular company that's being whipped around because of volatility, we often view that as an opportunity to add to a position. So we view volatility generally as our friend, and I would argue that a lot of what's happening with some of these day trading firms and individuals that are dominating certain stocks, I think that's creating volatility, which should in the long run help us and give us better entry points on some great growth companies. We always take a long-term view. We're always trying to identify the next great growth story. And the beautiful thing about innovation and change is that there always are secular tailwinds blowing in the market that will allow some companies to overcome any cyclical concerns, any interest rate concerns. So while we certainly don't ignore market cycles and we look to be opportunistic when we can from a cyclical perspective, we believe in the long run, the secular growth opportunities will win out. There's a happy sale and there's a not so happy sale. The happy sale is when we own a company, they've executed very well against a growth opportunity, and the market cap has really become too big for us to continue to hold it in our small cap growth portfolio. It's always hard to let those stocks go, but we need to make sure that we're maintaining our discipline and being a small cap growth manager. The not so happy sale is when we've owned a company where we've done a lot of fundamental research and we've developed an investment thesis, and that thesis is broken. Sometimes the thesis is broken because a management has misexecuted. Sometimes we have misexecuted and we've underestimated a competitive threat in the marketplace. Whatever the reason might be, we need to always be grounded in our thesis, and where there's an objective break to that thesis, we need to move on because there are many other companies that we can own in the small cap growth universe. I think active management is really important in the small cap growth universe. We've talked about the high levels of risk and volatility in the asset class. All of that creates opportunity, and there's such a strong potential for significant rewards if you are able to identify the next Tesla, the next Amazon, the next Microsoft. And you are not going to be able to do that and take a significant active bet in a passive fund. So the significant rewards need to be balanced with company-specific risks that exist. So there's always business model risks, there's execution risks, there's liquidity risks that we've talked about. And the thing that we bring, in particular our team here at Thrivent, we have a lot of experience. And I think the experience that we have is a really big positive in this regard. We've analyzed business models and companies across all industries. We've seen companies perform incredibly well, and we've also seen, what stumbling blocks can come up and that force a company to misexecute. So I think building upon the lessons that we've learned in the past from an active management perspective and incorporating that into our research process really gives us an advantage in trying to identify those next great growth companies. And I think it more than offsets the higher fees that investors are going to pay in our portfolio. At the end of the day, the great thing about being a portfolio manager is we learn something new every day. And there are new companies that are being created every day. And the more that you learn, the more you realize you don't know. And that's what makes each day so exciting. And it's what makes being a portfolio manager so much fun.